Good morning. Welcome to Monday morning's market wrap. It's a huge one today. We've got a big week for markets, and we've had a Chinese rate cut on Friday night. The rate cut and the reserve requirement ratio drop of 0.5% will or should put a flood of money into the Chinese economy. That's if the banks want to lend it. That's if businesses want to borrow it. Clearly, the government is trying to get the economy moving. Another example of probably why growth is nowhere near the 6.9% that was officially published a week or so ago. There weren't a lot of hints that China was going to ease on Friday, pretty much none. They normally do it over the weekend, but I'm really pleased that they did do it on a Friday night. That meant that markets were open. Certainly the big markets of Europe and America were able to react in real time. That means we haven't had a fractious, or we won't get a fractious open to the Asian trading session because our futures markets were open. Whether it's futures for the ASX or futures for the markets in the rest of the region, traders have been able to react. I think that's a much more sensible approach than doing it on the weekend and then having everything in currency markets and those sort of things concentrated into that Monday morning illiquidity that we have. And so it's likely to be a much more sensible reaction in markets than what we might have otherwise seen. It also gives traders in Asia a chance to see what traders in the US thought about the move ex post rather than ex ante the move, if that makes any sense, so that we can get on with things in Asia today. And it looks like it's going to be a good day. From a stock point of view, the Nasdaq ripped higher. We can ignore that one for a sec. It's got its own story, but it's above 5,000 for first time in a couple of months. The S&P was up 1.1%, 2,075. The Dow was up 0.9 to 17,646. In London, the FTSE was up 1. The DAX was up almost 3. The CAC was up 2.5. And what we've got is we've got a combination of Mario Draghi's promise of QE, quantitative easing, more free money in Europe, if you want to put it that way, and lower interest rates in Europe, even more negative for 2-year notes and those sorts of things, are combining with this China action. Now, China didn't ease because its economy is strong. It eased because the government, the PBOC, sense weakness, which is why the Aussie rallied from 72.60 up to 72.90 odd and then crashed back down to 72 cents. It's at 72.06 this morning and looking a little bit wobbly. If we have a look, we'll just go and head to the charts for a moment. If we have a look at, is that the Aussie chart? Yep, I'll blow it up so you get a better view of it. If we have a look at the Aussie chart, that is one heck of a long tail. You know, you don't have to be the world's best Japanese candlestick technician to say that's a market that looks a bit dodgy. So what you'd probably be looking for here, I think, is to see how the Aussie looks if it tests down towards 71.80, which was the low the other day. Test of there, break of there, and you get a cascade lower. The problem for the Aussie bears, though, is going to be the fact that if markets, what should I say? If the risk rally continues, and the risk rally would be stocks continuing to rise, bonds continuing to sell off in the US. Their 10-year sold off 6 points to 208. Both in Germany and in the US, the 2 years tried to rally but sold off and finished about 4 points higher. In Australia, our 10-year increased to 2.68%. So you're going to get bonds increasing. You're going to get, which tells you that people kind of, in a certain sense, believe the risk rally. You might even see emerging markets surprise everybody. You'll see a contraction in spreads because a more risk-seeking environment means that credit spreads for CDS, for sovereign governments, for corporate bonds in emerging markets should rally as well. And you might even see the Malaysian ringgit, Indonesian rupiah, other currencies in emerging Asia actually rally. Now, as counterintuitive as that might sound, given that the US dollar is thumping the heck out of euro down at 110, on its way to that 105 level we talked about last week, thumping the heck out of the British pound at 153, and thumping the heck out of dollar yen, which is back above 121 and almost 121.5. and a long way from my 116.50. Thankfully, I didn't have a lifestyle position in that trade. It could happen counterintuitively because the sentiment could just improve. So we'll have to keep an eye on that one. You could see markets tend that way. Now, if that's the case, if emerging markets do start to do a little bit better, if sentiment is buoyed and stocks do continue to rally, then the floor's got to come in under the Aussie at some point. It's inconsistent, or would be incredibly inconsistent, to have risk going on and the Aussie getting smashed. That doesn't happen sustainably, and hasn't happened sustainably that often in my quarter of a century career, or whatever it is. So just something to keep an eye on. I'm not getting too bearish on the Aussie. It's worth looking at the dollar Sing on that front, just to kind of talk about where the market is in that sense, and then we'll go and have a look at the S&P 500. A bit blurry because it's a bit small. What I'm trying to get you to see, and I can't blow it up, that's a massive tail on dollar Sing. This is the daily chart for Friday, and you've had a massive tail on dollar Sing. The reverse of the Aussie market, of course, that's because they're quoted different ways. So the thing to watch there is if dollar Sing starts to rise again as the globe's developed market, emerging market, if that makes any sense, and I know it probably doesn't, then that will give us a good lead, I think, on the Aussie dollar. Now let's have a look at the S&P 500. Let's go from the monthlies and draw back in time. So here's our big rally up to where this is the S&P, where the Nasdaq bubble was. Then we fell. Then we rallied back into 2006, 2007. We had the GFC crash, and then we've been in a rally now for quite some time. We've had this trading range up here and broke down, and now we've had a massive month. The S&P is up something like 11% from the lows. In weekly terms, and I know I've said this before, but we found a bottom near the bottom of 2014, which is a positive. And we also, in terms of my system and the way I trade, we had prices go outside the Bolly bands. That's not normally sustainable. Remembering I'm on a weekly, we've had the MACD suggest to me that prices needed to recover pretty much from that point, which was around, where are we? Around there. Right, so we've got that weakness, and then we've gone higher, and now we're breaking back up into the trend line that, as you saw, if I, goes back to the low in 2011. Now, the important point about this trend line is that this was the start of the GFC rally back here. Well, the trend line that supported that rally before it broke down then became resistance. Now, I use that as an example of just sometimes, well, I always believe you've got to have charts in your arsenal, but, support becomes resistance, those kind of things. It's important to remember and to look at that. In terms of the dailies, looks like a heck of a mess, I know, but the important thing here is that that's the 200 day moving average just here. Second day in a row, we've closed above it. I personally think it's starting to look stretched, but if I shrink it down a bit, you could run up into the, the 2100 definitely, and then maybe even up to the top of that range. It's looking stretched, but markets can get stretched topside and downside for some time before they reverse. Brian Belsky, who's the guy from Bank Montreal, so BMO Markets, he made a call back at the end of middle to end of September, I think, when markets were still in ructions, and then we had that terrible Friday sell-off in the States. And he made the call that you should be buying stocks then. He came out on the Monday after the sort of the mini crash of the mini crash in September, and said, no, double up, buy in. And then today, or over the weekend, he's published some research which you'll find on Business Insider. You'll find it linked in my 20 seconds piece from Business Insider or my Go Markets report. What he said was buy stocks. And his argument is largely the one that I made last week, which was people will be scared of missing the boat now. They'll be scrambling. And of course, I'd add that the shorts are still short. CFTC data released on Friday night still showed that the speculative community, at least, is short futures. Now, that's just an indicator, but it's an indicator worth watching. So you're going to get this scramble. Now, the question of sustainability, I'm in the camp from a rhetorical and fundamental point of view that says there's no way that this rally is sustainable. But we'll have to see how earnings go this week. And Belsky thinks it's the market's on its way to 2,200 or something like that. There are no signals in any of my timeframes on either the daily, weekly, or monthlies just yet that the S&P is a sell again. So we're just waiting for the signal, and maybe we go short, but otherwise you just got to run with it. So on the data front today, there's not a lot. The Aussie dollar we've talked about, the euro's down at 110. It looks like it's probably going to 108.50 or something like that. I think was the level we talked about on Friday. It's broken down from the trend line that supported it from the lows of earlier this year when it got down to 105 or just under, and it does look like it's going lower again. The question now, of course, is what the impact of all this has on the Fed. A couple of things. The Fed mentioned conditions abroad, that's China and emerging markets, when it didn't move in September, but it also mentioned the US dollar. So on the one hand, China and the actions of China supporting risk, supporting emerging markets could be good for the Fed, but the dollar index is up at 97.11. That's the highest level it's been since early August, and close to the highest level. Let me just have a look at a one-year chart. Yeah, basically back towards the top of the range we've had for the last couple of quarters. And the dollar and its strength was one of the things mentioned by Janet Yellen in her press conference with regards to another reason why the Fed had stayed their hand in September. So lots of moving parts, lots of competing forces, normal thing. The Fed's got a meeting this week, starts tomorrow night, Australian time, two-day meeting. No one expects that they will be moving rates. But as Mario Draghi showed last week, markets these days, words are powerful tools. So any changes to the statement could have some very big impacts on markets and how they go. So I'd recommend you have a look at my Oz diary, which is also on Business Insider. That's the one with the picture of the horses, because I just sort of said, buckle up, the horses are on the track. So let's see how it goes. But otherwise, that's it from me. Have a great day's trade. Technicals are once again proving your levels, your trend lines, all those kind of things to be great guides in this market. This is not an advice column, you know that. You've got to look to your own way that you trade. But from my point of view, technicals as part of the toolkit is really important, and it also tempers the rhetorical nature that you could have. So a lot of these guys that are caught short the S&P now, nobody who watches this video, once again, this is not advice, but no one who watches this video and takes lessons from the tools that I use could arguably been caught short the S&P. It's just not possible. The reason for that is that you just go with the market. Now, I've got a lifestyle short in the S&P, but that's a long-term thing. That's like my super. All right. From a trading point of view, that's a different matter. You just got to trade with the way that the market points. So the euro's breaking down. There's no sell signals in the S&P yet. There will be soon, I'm sure of it. But there again, that's a rhetorical getting in the way of what the charts tell me. On the weeklies, we could have another week or so of good price action before it reverses. Anyway, I've made a bit of a mess at the end of this today, but anyway, I'll leave you with it. I'll see you tomorrow morning on Tuesday around 9 o'clock. You can catch me on Twitter at Gregory McKenna. You can catch me at Business Insider. You can catch me at my own website, gregmckenna.com.au. Have a great day. That's it from me. Bye for now.